Hello, with me today I have John Meyer, mining analyst at SP Angel. Hi, John.
Hi there.
Look, 6 months ago, you told me that the argument for investing in mining stocks was the best that we've seen in the last 20 years. But the FTSE 350 mining index, it's fallen sharply, as has the price of copper, seen as a bellwether of economic output. Now, there's a lot going on in the industry at the moment. So what's driving sentiment?
Yes, there is a lot going on, and sentiment is driving everything right now. There's a shortage of liquidity in the market as of about 3 weeks ago, and that has served to pull back a lot of stocks. And really, that's technical, because so much of what's going on is just driven by liquidity flows of investors wanting to pull money out of the market, wanting to do other things, go on holiday, build extensions, etc., etc. But at the same time, we've got this big macro event with so much more inflation in the world than we had predicted, or anyone else had predicted, and this has caught policymakers by surprise. So what we're now seeing is the Fed reaction to that is fairly extreme, to hike interest rates. They've already done a 75 basis point hike, that's 0.75%. They're threatening another 75 basis points plus another 50 fairly quickly after that. So this, we think, it's a fairly extreme move, but this is to hit inflation hard and knock that back. And I think they don't mind if there's a little bit of a recession that comes off that. I think it'll more likely to be a technical recession than anything else. But the impact of all this is that the US dollar has strengthened. The carry trade, which we're aware of, which is where hedge funds tend to benefit from the interest rate disparity between the US and Japan, the US and Europe, the US and UK. That means that they buy US treasuries, they buy US dollars to earn that interest rate, and then they profit from that. So it serves to accelerate the move higher for the US dollar. And when the dollar rises, commodities become more expensive for everybody else in the world. So what that means is, if you're in India or China, you say, well, I don't want to pay quite so much for my copper or my nickel or my tin today. Therefore, it tends to pull the price back a bit. So that's a technical move. At the same time, if the West creates, shall we say, a micro recession, or even a longer term recession, that means that slightly less commodities will be used. Plumbers will buy less copper piping, for example. Warehouses that supply those plumbers and the electricians and others in the building trade will stock slightly less of that material. So everything slows down, which is exactly what the policymakers are looking to do. And given the exuberance that we were getting post-COVID, or it's wrong to say post-COVID at the moment, but that exuberance that the West was seeing as we came out of COVID, driven by liquidity that was pumped into the system to avoid a collapse during Western lockdowns, that needs to be reined back in a bit. So it's interesting. And at the same time, we've got a situation in China where they've discovered yet another subvariant of Omicron. It's one of many, this time in Shanghai, and certain parts of China are locking down again. So there's a cat and mouse game going on in China about COVID, how to deal with it. Do they maintain zero COVID? They've now changed the terminology to a dynamic zero COVID policy, and I think what that does is it gives local authorities a bit more room to maneuver around with, so they don't have to completely lock down everything. They can maybe restrict movement in certain areas in order to try and slow the progress of the Omicron variant as it moves through society.
Well, look, I mean, what's the outlook for the global mining industry in the second half of 2022? I mean, you've mentioned sort of a possible recession. Do you have a house view on the odds of a recession either in the UK or globally?
Well, we certainly feel that there is a high risk of recession, but we feel it's more of a technical recession. That yes, there is this slowdown, and the slowdown is more a loss of confidence. Now, some of that is in relation to Russia invading the Ukraine and disrupting various supply chains. Some of that's because of other supply chain disruption that we've already seen in the system because of the Chinese lockdowns. So there's a number of things going on here. So certainly our view is, yes, things are going to slow. I think we're looking for more of a mild recession in the UK than anything else. Probably a little bit harder in the US because things tend to be a bit more stop-start over there. But I don't think it's going to last very long. And that's why I say I think it's more of a technical recession than anything else, because I think what will happen is policymakers aren't going to want to see this going on. Remember, there's still a kind of economic competition. I almost want to use the term war, but an economic competition between the US and China, where the US is trying to reshore manufacturing industry back from China and get more jobs back into the United States. And certainly the jobs growth figures in the US are looking good, so that's definitely been working, although quite a lot of the reshoring seems to have moved into other low-cost areas. So countries like Vietnam and other Southeast Asian countries are benefiting because they've got relatively low labor costs, and manufacturing that was happening in China is moving into these countries. And that's being accelerated by the uncertainty of operating in China right now, with factories being shut down.
Well, I mean, looking at some of the individual companies in the sector. Now, you tipped Glencore in 2021, and the shares returned over 80%. When we spoke in December, you went for Glencore again in 2022. While global financial markets crash, I mean, Glencore shares were, or still are, up around 8%, I think, this year. So that's great, but they were up as much as 40% not too long ago in June. So the price has fallen back since. What's the outlook for Glencore for the rest of the year?
Well, I remember saying when I joined an American bank years ago is don't fight the market, because you can't fight the market, and when liquidity drains out of the market as a whole, or even just out of the sector, you shouldn't try and stand in the way of that. Glencore is still a good company. The key drivers that drive Glencore, the trading business, the coal business, are still doing incredibly well. Yes, the copper business, the nickel business will see lower margins now, probably for the next 3 to 6 months. But I'm still pretty bullish about the prospects for copper, tin, nickel, these battery metal commodities, because there's so much demand for these commodities, and there simply aren't enough mines to supply that future demand. So it's difficult to see prices staying down at these levels for very long. And I think we're going to see another spike in prices, or at least a rise in prices, later this year and certainly into next year, assuming that interest rates get pulled back a little bit.
Okay, well, I mean, that sounds like it could be good news for the small cap mining space. So it was a mixed first half for, I think, small cap miners. Do you think they'll do well in the second half of this year?
Well, it was a good first quarter, and it's been difficult for the last couple of months. Yes, I do think that. I think there's going to be quite a strong recovery later this year, and I think the summer months, although liquidity is low, will provide good opportunity for investors looking for bargain prices, assuming that they've got the cash and the time to look to allocate that.
Are there any that stand out for you, John?
I'm pretty positive on a number of areas within the market: lithium, tin, rare earths, and copper. And when we look at the companies that we act for, these are the companies we trust and we understand, and of course we work closely with. So we act as nomad and broker to most of these. I would start off with Atlantic Lithium, which I think is a good quality lithium company, working in Ghana. It continues to work through the project. It had a setback when its chief executive very sadly and very suddenly passed away. But the new man who stepped forwards, well, I say new man, he's been in there for many years anyway. So the new CEO is doing a great job. And so the disruption that they had from the former CEO, Vince Mascolo, dying, that's now done. And the company, I think, is set on a good path. I would then also look at buying Rainbow Rare Earths. Again, we're Nomad and broker. We're financial advisor and broker to this one. They have a really well set project in South Africa called Palabora. They're retreating a tailings dam. It's very big. It's about 38 million tons of tailings. Those tailings are rich in rare earths, and they've developed a continuous iron process for the extraction of those rare earths. And there's very good reason to believe that this will work, not just work well, but work at extremely low cost. So I think the capital cost of building the plant is going to be quite high, because these sorts of hydrometallurgical processes are quite expensive to build, but actually the operating cost should be really low, and I think that will more than offset the capital for building the project. So I'm very positive and enthusiastic on Rainbow Rare Earths going forwards. Cornish Metals. Cornish Metals have the South Crofty tin mine in Cornwall, and they're also drilling at United Downs. And I like the United Downs project. The grades are looking good. It's too early to say whether it's going to be a definitive mine, but my money would be on that. But in the meantime, they are dewatering the old South Crofty mine, and they'll be able to get back into that and start building a process plant and making that work in the next few years. So I'm very encouraged by the work going on at South Crofty, and I'm a big fan there. And maybe I would be, because I did work in the mine as a student many years ago. Last but not least, Rambler Metals and Mining. They announced this morning that they announced that they had just hit their target grade of 2% from the Ming mine in Canada. So that's all going very nicely. Tonnages are up, and as a mine, this has just come right. So I'm very happy to see Rambler doing so well, and I think that's going to be a key stock to see in the rest of the year.
Okay, now John, lithium futures prices have more than doubled in 2022 so far. They're up, I think, about 400% in the past 12 months. Now, what's behind the rally, and what are the odds of it continuing?
I think when prices are so high as this, it's difficult to absolutely know where it's going to go. I mean, certainly over the next 10 years, I would expect lithium prices to pull back. Nobody is using the current level of lithium prices in their feasibility studies or their resource estimations, where you also use a price estimate to work out what's economic and what isn't. So yes, I think lithium prices are going to remain relatively strong over the next 10 years. I think a lot of that's going to be driven by the need for more hard rock lithium, or lithium spodumene. But at the same time, there is the potential for more lithium to come in from brine sources. This is where they process liquid brines, which are rich in lithium, up in the Atacama in Chile, maybe up in the Atacama on the Argentine side as well. There are some other people looking at processing lithium brines out of Cornwall and out of Germany, particularly with geothermal brines, and I think those will work. But what you need to have is the right chemistry when you have a brine, because not only have you got to upgrade the grade within that brine, but you need to be sure that there aren't too many nasty elements, other elements that will cost a lot more to extract or take away from the processing of this. So it's a very technical area. There are only a couple of companies in the world that I would trust to get it right. Cornish Lithium hopefully will be one of those. They have the added benefit of having the heat from the geothermal brines, which is very helpful. There's Vulcan Energy, which is Australian listed and working in Germany. And then you've got Clean Tech Lithium, which is working out in Argentina. They're AIM listed. And I think they certainly have the right approach. They're looking to process a brine salar in Chile.
Right, well look, I mean, after a spike above $2,000 an ounce in March, gold is back to prices last seen in September 21. So, I mean, is gold still a haven asset and something that investors should own in their portfolio? This is a conversation that is had regularly, and investors continue to ask it. So, should they own gold?
Gold always has a place in a portfolio, and to be honest, I've never owned enough of it myself, because it always feels like it's an asset that doesn't necessarily earn its own money. It's not like holding a treasury. It's not like holding a stock that will pay a dividend. You can, if you're a big player, earn a small interest rate off gold, but that's by the by. But the fact is, when the world collapses, and let's say if you're a big holder of cryptocurrencies of various sorts, you might feel that the world has collapsed a bit by now. Gold will pull back, but gold recovers very, very fast. And there's always more than enough liquidity to buy and sell into. It's a huge, huge market. And it does have the confidence, because what happens is people park money into gold while they're looking for other things to buy. So it becomes this sort of default depository for funding. And yes, it means that actually holding gold is almost always quite a secure thing to do. So that combination of factors that makes gold popular, not just the fact that people like to physically own gold, but the popularity of it over the last 10 years, where gold ETFs have risen to over 100 million ounces, says that gold to me is still a very solid place to store a certain amount of wealth, particularly for when times are very uncertain and times are looking tough.
Okay, so I mean, looking ahead to again the next 6 months of this year, where's your money going? I mean, any metals that you think will outperform others, and if so, how can investors get exposure?
Well, I'm holding stocks in copper, tin, and I'd like to own some nickel, but it's difficult to find a good nickel stock in the UK. So that's where my money is. I wasn't quick enough to necessarily get everything out when liquidity was pulling back, but there we are. It's just how the game goes. But that's where I see the growth coming. Rare earths, I'm looking to buy into rare earths, and Rainbow is my key story there. And then I think there'll also be some recovery in iron ore, but that's something for the big players, for Rio Tinto and BHP. And I think Glencore is still my favourite. Yes, I think investors have got to wrestle with their consciences on whether they want to buy into coal or not. But frankly, I think coal is the lesser of two evils. You either buy Russian oil and gas and Russian gas, or you need coal for Western power stations. So my money's with coal for now, although not on a long-term basis.
Excellent. John Meyer, mining analyst at SP Angel, thank you very much for joining me today.
Thank you.